Good afternoon and welcome to our signature event of the year, the 2021 South Orange County Economic Report, brought to you by UCI and UCI Health. My name is Steve Lamont and I serve as the chair of the South Orange County Economic Coalition, as well as the executive officer for the Building Industry Association of Southern California, Orange County chapter. Since 1969, the South Orange County Economic Coalition has served as the premier voice of business throughout the region. We promote a strong economic climate and provide updates on current events impacting our regional and local businesses. Today, we deliver on this promise by bringing you our annual virtual economic report on the state of our economy. To help understand where our economy stands today, and more importantly, where we are going, we are honored to welcome renowned economist Dr. Christopher Thornberg, founder of Beacon Economics. Dr. Thornberg delivered our 2020 virtual economic report and is back to share his unique insight on the future of our economy. 2020 was an economic year like no other in recent history, making today's discussion both timely and necessary. We are thrilled that you have taken the time to join us today. This event could not be possible without the generous contributions of our sponsors. In particular, our title sponsor, UCI and UCI Health. UCI Health's slogan is "Stop at Nothing," and we hope that this optimism and enthusiasm for the future will be imbued in our local economy in South Orange County as we emerge from this global pandemic. We'll be right back with Dr. Christopher Thornberg after a brief message from UCI and UCI Health.
The future of healthcare is here. With approval to build UCI Medical Center Irvine Newport, UCI Health will bring the unparalleled expertise and quality care of Orange County's only academic health system to coastal and South County residents. Our state-of-the-art acute care hospital, alongside 2 outpatient care centers, will offer a 24-hour emergency room, urgent care services, easier access to leading-edge cancer treatments, and clinical trials from our NCI-designated Comprehensive Cancer Center, and exceptional inpatient and outpatient care by our world-renowned experts in every discipline, from digestive disease to neurosciences and orthopedic surgery and cancer care. At UCI Health, we will stop at nothing to build a healthier Orange County.
Welcome back, everybody. It's great to be back with you. It's been a very long year, but I'm thrilled to be with the South Orange County Economic Coalition yet again to update what we talked a little bit about last year. Where is the economy heading with, of course, the pandemic? Let's get right into it. My talk today really is based on 4 big themes. Themes, by the way, we touched on last year, and I think played out pretty much as we had anticipated over the course of this year. The first theme is this. The COVID pandemic obviously was tragic. You're talking about 500,000 Americans have perished from the malady, which is a truly astonishingly large number. But from an economic perspective, the damage was nowhere near as severe as a lot of forecasters have been predicting last year. You remember there was a lot of conversations about depressions and predictions that this thing was going to be as bad, if not worse, than the Great Recession. And of course, every bit of evidence tells us that this is nowhere near the Great Recession type situation, nor is it going to have any of the long-run consequences. Very good news on that particular front. The second main point of today's presentation is this. Despite the fact that all the data suggests that the recovery from the COVID recession has already been fairly significant, the conversation at the federal level has not acknowledged that whatsoever. And we have seen a phenomenal amount of stimulus put into place last year, and of course we're adding to it this year with another $2 trillion program that is currently working its way towards final passage in Congress right now. And the result of these packages is really twofold. A, it's taking what would have already been a relatively quick recovery, and it's turning it into a incredibly rapid recovery. Hence, of course, the title for my presentation overall, Prepare for Acceleration. But on the other hand, the degree of monetary and fiscal policy has been so over the top that it will be introducing what I would call dangerous instabilities into this new expansion. And that's something, again, we're going to talk about in quite a bit of detail a little bit later in this presentation. The third thing, of course, has to do with the long run. We heard a lot of conversations about new normals and what it all meant. But I will tell you that there is no new normals coming out of this pandemic. After all, epidemics have been with humanity since the dawn of civilization. We have persevered in the past, and there's no, of course, reason to not think that this time we'll yet again persevere. It will, however, accelerate very specific underlying trends in our economy, and those we have to pay attention to because either from a business or a policy standpoint, we have to acknowledge the acceleration of these underlying trends in terms of thinking about how do we deal with this next expansion. And then last but not least, politics. Obviously, we had a very ugly election last November. It's done, it's behind us. We have a new administration in office. But to be clear, what everybody should recognize is even though President Trump is no longer on the inside, he's now on the outside, obviously the degree of political rhetoric, the extreme political rhetoric we're hearing from both sides of the aisle hasn't gone away, which goes back to something very important. The political divide in this country really was not generated by President Trump. One would say he was a politician who took advantage of those divisions in order to launch himself into power. Those divisions are still in place, and it's something we all have to be paying attention to because, candidly, neither side of the aisle is talking about what I would call issues in a way that's appropriate. And indeed, not only is this extremism on both sides, yet again, going to prevent them from dealing, if you will, with the desperately needed reforms at the national level, but at the same time, of course, it continues to distract them away from the true underlying issues where there's a lot of conversation, a lot of focus on things that candidly are going to do very little good for the U.S. economy in the short run. So 4 big themes. Let's keep those in mind as I go through this. I have a lot of material as always, so let's dive right in. First and foremost, one of my key themes over the past bunch of years is this idea of miserableism. That is to say, whether you're talking about politics or whether you're talking about the press, every time you hear a story on the economy, not only does that story have to point out to you that the glass is half full, it also has to tell you that it's emptying rapidly. This constant need for pessimism has become really ingrained in what I would call the culture of the times, as the case may be. And that need really took on a whole new scope, a whole new scale in the context of this pandemic. We've heard all sorts of incredibly negative predictions about what this pandemic was going to mean for our economy. A depression-type situation. Home prices are going to fall. Commercial real estate markets are going to blow up. We're going to see financial problems on par, if not worse, than what we saw in the Great Recession, and so on and so forth. Now, again, there's no doubt that this pandemic itself is a tragedy, and our hearts have to go out to those families who've lost loved ones. But as tragic as that is, very much like other natural disasters, as tragic as the consequences for the population are in the short run, they tend not to have long-run economic consequences. And that was what I was really bringing to the table last year when we had this conversation. And what that meant, of course, is that even with the pandemic around us, we still anticipated a certain degree of recovery and then a very rapid recovery once we got control over the virus, the V-shaped scenario. Now, again, that's a little bit different than what most of what you were hearing was about a U-shaped type situation. This was going to be a long, painful economic cycle even after we got control over the virus. We didn't buy into that. We said V, and candidly, we were pretty spot on that particular front. Look, this recession was the deepest we've ever seen in the U.S. economy. It's also the shortest. The recession began in February and it ended in April. And by the end of the year, we had recovered 70% of the lost output that occurred in that 2-month downturn. Not all the way. Obviously, when you think about towards the end of the year, the recovery stalled a bit, but that's not to be surprised about. After all, we had an enormous surge in new cases, just as the epidemiologists had feared. We got into winter, people went indoors, and as a result of that, we had a huge new surge in cases. But again, think about the difference between the first surge and that final surge of the virus at the end of last year. The first surge, very small, caused a meltdown in the economy. By the end of the year, the enormous surge in new cases we had, the only thing you could say is it stalled the recovery. So, in other words, we have come a long way from where we were 1 year ago today. We've mitigated quite a bit. We learned to live with the virus, and more importantly, we are now getting in front of the virus. What did happen last year? Well, let's take a look at the overall numbers. The CBO, when they originally put out their predictions for what this recession was going to look like, had suggested that we were going to see an overall decline in economic activity relative to what we should have been able to make without the pandemic by about 6.5%. And then they predicted about another 4% loss in economic output in 2021. What actually happened last year? We only saw about half of that in terms of overall loss. Remember that big 70% bounce back we saw? We only saw about, the U.S. economy performed about 3.5% below trend, as the case may be, for all of 2020. It was actually a relatively good year because of the big bounce back in economic activity. By the end of the year, overall GDP was about 2.5% below where it was at the start of the downturn. What parts of the economy contributed to that overall decline in things? By far and away, the biggest source of the downturn was in the consumer services sector. We're talking recreation, entertainment, whether it's Disneyland, hotels, restaurants, so on and so forth. This obviously was the majority of it. Now, other than that, we did see a bit of a slowdown in business investment, but that was kind of a mix because while it was true that investment, particularly in commercial structures, was way down, we saw actually pretty good numbers in terms of electronic equipment, software, and of course, housing has been absolutely on fire. On net, it kind of was a wash overall for the U.S. economy. And imports have come back quite a bit as well, largely because, of course, of the strong consumer spending. So overall, big solid bounce back in the year. Why? Why was it so rapid? Well, let's go back to what we talked about last year, the whole idea that this is not a Great Recession type scenario. You remember, the Great Recession occurred after an enormous subprime bubble had extremely overheated the U.S. economy and created an economy that was highly distorted in all sorts of ways. This time around, the pandemic occurred in the midst of a slow period at the back end of a modest, healthy 11-year expansion. We didn't have any of those major imbalances coming into the pandemic type downturn. You think about consumer finances. Back then, we had a record high debt to income ratio, record low savings rates. The household sector was incredibly vulnerable to any kind of meltdown in the financial markets, which is one of the reasons why it hurt so bad. This time around, we entered the pandemic with a record low financial obligations ratio and a 30-year high in savings rates. In other words, households were overall far more equipped to deal with a moderate disruption in income or employment than they were back during the Great Recession. Housing. Back then, we had incredible spike in prices. A huge share of housing was for sale for rent. Way too much home price growth and, of course, way too much supply overall. This time around, we came into the pandemic with a housing market that was cool because of some of the changes in tax policy and rising interest rates we saw in 2018 and 2019. But fundamentally, it's one of the healthiest housing markets we saw. And indeed, from a supply standpoint, was very supply constrained. Not the kind of housing market that's going to melt down. The recession driver itself, back then, it was a demand shock. There was a collapse in wealth that caused people to want to save more. Hey, I thought I had this house that was worth this, but it's not. I had a stock portfolio that was worth this, but it's no longer worth that. My wealth has gone down, but I still have all this debt. We have to save more to rebuild our financial position. It wasn't just households. The banking system got clobbered as well. They had to rebuild their households. We had too many homes. We had too many cars, causing flow stock issues in those particular industries. In other words, it was a long-run situation to rebuild our economy in the aftermath of that massive subprime bubble. This time around, it was not a demand shock created by underlying problems that preceded the pandemic. Quite the opposite, this was a supply shock. And what I mean by that is that people weren't going to Disneyland, they weren't going to restaurants, not because they couldn't afford to, but because they weren't able to because of the pandemic. That's a critical difference, because if you can't afford to go to a restaurant, that situation will remain in place until you can afford to go, which takes time for the economy to recover and get back to normal. This time around, people will go back to restaurants, they will go back to Disneyland as soon as we get control over the virus, as soon as these restaurants and Disneyland are reopened. It's a critical difference, and yet again, it's one of the reasons why we've been talking about the V right from the get-go. And last but not least, government stimulus. Back then, it was too little too late. This time around, it was too much and too soon. Now, again, from a short-run standpoint, this is good because you're going to see the economy absolutely take off like nobody's business in 2021 as a result of the excessive stimulus. But as already noted, it is going to lead to instabilities, potential problems that we all need to pay attention to as we move forward over the course of the next couple of years. Now, the way to think about this, what happened is, I like this graph right here. This is an estimate of monthly GDP. And the reason I'm showing it to you is it kind of gives you some sense of the phases of the pandemic business cycle. The first phase was, of course, the recession itself. This was this 2-month period. Remember, we peaked from an economic standpoint in February, and then the pandemic took hold and we saw a massive decline in economic activity. The bottom of the downturn was in April. And the MBER dates recession's peak to trough. Yes, this was a 2-month recession. Now, after that, we got into the first phases of recovery, what I call recovery part 1, mitigation, learning to live with the virus. 70% bounce back in economic activity by the end of the year as a result of mitigation, people figuring out how to live their lives when the pandemic was around us, businesses figuring out how to do business when the pandemic was around us. This contributed significantly to the bounce back in economic activity. Now, the economy cannot get back to normal fully until we conquer the virus. And that's the next part of the recovery, what I call the post-COVID recovery, when we finally do control over this virus and things can start getting back to normal. We are entering that phase relatively rapidly. Again, estimates suggest that most adults will be able to have this vaccination by the end of May, in the middle of the second quarter. This, of course, means the second half of the year is that post-COVID recovery phase. And then last but not least, after we get through that, we get back to normal levels of economic activity, we enter the new expansion, and then we have to start talking about, are there any new normals or not? What kind of underlying trends have been accelerated by, of course, the pandemic? Now, when you think about that recovery, it was very much a winner-loser recovery, which when you picked up the papers, you heard all about the businesses and the workers who were suffering. And there's no doubt there's still a lot of those folks out there at this particular point in time. What you didn't hear as much about is the fact that there were also winners, parts of the economies that were excessively stimulated as a result of the pandemic. For example, the basic mentality in most households was this: hey, we can't take the kids to Disneyland, we can't go to our favorite restaurant for that nice meal, so I got to tell you what, let's go buy a camper and bikes and we'll take a 2-week trip driving around the national parks. As a result of that, you saw a big shift away from services into goods. And goods spending through the second half of 2020 was on fire, way above trend relative to anything we'd seen over the last 10 or 20 years. The winners on that, well, right off the bat, online retailers. We know Jeff Bezos and company picked up a lot of new customers in this midst of pandemic. As of January of this year, you're talking about a 30% increase in online sales relative to the previous year. But after that, sporting, hobbies, hardware stores, you look at your typical Home Depot, busy, food stores, furniture stores, and of course, auto dealers, all very, very busy. So this part of the economy did very well. They were making good money, hiring additional people, and it went a long way to rebuilding part of the economic activity. At the bottom end of this, of course, we know restaurants and bars have been hit really hard by this situation. Clothing stores, that represents really malls more than anything else, and of course gasoline stations, because we're not driving as much. So these parts of the economies are suffering, but other parts are doing very well. And with the goods part of the economy roaring back, so too has the production part of our economy. Take a look at industrial production trends. Yes, it was a huge downturn at the beginning of this, but look how rapidly it came back. Indeed, in the first 6 months of this recovery, we saw as much recovery as what it took 4 years to happen in the midst of that Great Recession. That's just how quick of a bounce this has been. This is the V we were talking about. And of course, with goods spending going up, and imports have also bounced back strongly. Now you notice one of the holes in the economy is the export market. It's come back, but it's weak. And that's because the global situation is worse than here in the United States. They're behind us in terms of new vaccinations. A lot of countries were getting hit by this even late into the year. They're having their first serious wave of this problem. And exports still lagging, but those import markets are really, really busy. And with that big bounce back in spending, you also saw, of course, a really quick bounce back in taxable sales. The numbers here are really, really telling. At the bottom, of course, of these 3 lines is the county of Riverside. just east, of course, of Orange County. Riverside's taxable sales by the third quarter were back to normal. That's how fast the bounce back in overall spending activity was. Now, for Orange County and LA, they lagged. Why? We'll take a look at the hotel data to the right. Again, it tells a completely different picture between what was happening in Riverside and in Orange County. The hotel system in Riverside has actually been busy, whereas Orange County, one of the worst in the state, next to San Diego and San Francisco. What's going on here, again, is a winner-to-loser type situation. Basically, if you think about fly-in tourism, whether it's San Francisco or flying into the Orange County's airport to go over to Disneyland, well, these parts of the economies were absolutely hammered. People were not flying. They were not doing any kind of what I would call that airplane-driven tourism, and these economies that rely on that were suffering. Riverside's different. It's a drive-in type tourist situation, whether you're thinking of Temecula or Palm Springs. And boy, people were so eager to get out of the house, even in the midst of the pandemic. Drive-in tourism was great. Even here inside Orange County, you could see that. The hotels next to Disneyland, absolutely empty. Nothing going on there. But if you go down to, say, South Orange County, you go to Dana Point, some of those luxury hotels on the coast were packed with people throughout much of 2020. Because again, it's driven by drive-in tourism, that winner-loser framework we've seen in so much of the economy. And that's one of the reasons why taxable sales in Orange County and LA have been lagging behind places like Riverside. It's driven again by that fly-in tourism market that of course stimulates a certain degree of local spending. Now, as noted, some parts of the economy cannot recover until we get full control over the virus. Restaurants, transportation, that's mainly airplanes, and of course entertainment. This is some data from Opportunity Insights. That's a data shop out of Harvard University that very, very kindly created a lot of available data for economists to take a look at, very high frequency data. Indeed, this data brings us into about mid-February. And you can see how these parts of the economy still lag behind. You simply cannot have full operation of restaurants or recreation until control of the virus is actually had. We are getting control of it, and you're already starting to see that bounce coming into the first 6 weeks of this year. And good news, again, suggesting we're getting back to normal. And this, of course, has been driven by the rollout of the vaccine. A lot of news about the rollout of the vaccine being a little clunky at first. That is true. But you know what? We're getting close to almost 2 million doses per day. This is good data. You take a look at where we are right now. Steer the population that has gotten at least one shot here in California. Right now, we're running about 16%. Not bad, getting faster every single day. And as a result of that, of course, the number of cases has been coming down very, very sharply. You know, on January 8th, the nation was facing about 230,000 new cases per day. By February 27th, that had declined by 75% to 67,000. Now, the decline slowed a bit. We know that. New variants are coming out. People are getting a little bit, shall we say, sloppy because they are more comfortable out there. And the rate of decline is slowing a bit, but we're still getting down there. Very, very good news. And as long as we don't see any new variants that are truly resistant to the vaccine, I anticipate, again, by the second quarter of this year, this pandemic will be truly over. You're still going to see things cropping up here and there, but it's going to be a moderate number of cases, and it's not going to spread like wildfire, and we're going to be able to reopen our economy. In California, the news is even better. Here's some recent data we have on that. And you can see hospitalizations have dropped tremendously. Indeed, you know, at the end of the year, California was significantly worse than the nation overall. Coming into the beginning of March, we're better than the nation overall. Whether you're looking at new cases or whether you're considering the hospitalizations, clearly California has really gotten forward. And as a result of that, you're starting to see policies change. For example, it looks like Disneyland's going to reopen by April 1st. Not full, but it's going to be partial. And as time goes on, more and more folks will be allowed back into the park. Anaheim's going to be turning on again, and obviously that's good for all of Orange County. With a bounce back in economic activity, there also was a bounce back in what I would call overall business investment. Indeed, this shouldn't have been much of a surprise. The profit hit this time around was nothing like what we saw last time around. Take, for example, financial profits, which got clobbered in the midst of the Great Recession. This time around, the financial industry continues to make good money. And non-financial businesses, big hit in the second quarter of the year, but by the third quarter of the year, profits had gotten back. Win or loser, some parts of the economy still behind, but other parts of the economy were making excess profits because of the excess demand being driven by, of course, conditions that we were living under in the midst of the pandemic. Commercial real estate is one of the weaker parts out there, and commercial real estate obviously is a big driver of the Orange County economy. What are we seeing here? Well, vacancy rates pretty much across the board have started to drift up, but it's a completely different story when we dig in just a little bit deeper. Top of the list, of course, the part of the economy that has really shown its worth is the industrial part of the economy. And that, of course, has a lot to do with local distribution. Remember all the new sales that moved online, which meant they had to get delivered to your home. And that put, Amazon can't open warehouses fast enough at this particular point in time. Now, the issue with industrial over the last few years had a lot to do with the fact that we were building more than we needed. There was still positive net absorption, but it wasn't enough to absorb all the new space. But we saw a huge pop in net absorption by the end of 2020, and vacancy rates in industrial yet again starting to go down. Contrast that to office. Now, office was also building a lot and didn't have enough of net absorption to absorb that. Hence, vacancy rates in office into 2019 were drifting up. But you got into 2020 and you started to see negative net absorption. People were basically getting rid of office space if they were able to do it. And as a result of that, the vacancy rates that continue to rise through the end of the year for office space, well, those are going to stay in place. We're going to talk about that a little bit later on when we start thinking about what does this mean from a long-run perspective. Here in Southern California, a very similar sort of picture. You're seeing office vacancy rates rise. You're seeing, obviously, industrial rates rise until the end of the year. Very, very similar picture to what we're seeing in the nation overall. And as for retail, well, again, because of some of these eviction moratoriums going on and because retail landlords are really not up for kicking retail folks out. You don't want holes in your shopping plaza. You haven't seen much of what I would call an increase in vacancies there, but you are seeing rapidly falling rents. Now, in terms of overall construction, it's been pretty steady through 2020, building new buildings. But that's because commercial real estate construction is very much a lagging indicator. If you look at permits in Orange County and LA, they dropped substantially in 2020. Not a big surprise here. A lot of worries about what was coming next in the commercial real estate markets here. It's going to be a weak couple of years. This will be one of the weak parts of our economy moving forward. And you can certainly see it here in Orange County, where yet again, 2020 levels of new construction. But mind you, permits overall were really about on par with what they were in 2017 or 2016. They weren't that low, but obviously substantially lower than the big boom in new building you saw in 2018 and 2019. Not too much of a surprise. Better news comes from looking at the transactions part of the economy. Because again, this could all be intensified if you saw a meltdown in overall transactions, falling property prices, any kind of problems in debt markets. None of those things have emerged because again, we entered the pandemic with a fundamentally healthy financial market, with a fundamentally healthy debt market, with a fundamentally healthy commercial real estate market. We didn't have excess supplies. We didn't have rampant speculation, which would create some sort of major meltdown. By the end of the year, you started to see a pickup in transaction for commercial real estate, and banks are already feeling more comfortable. We get something called the Senior Loan Officer Survey from the Federal Reserve. They ask banks, are you changing your credit standards? We saw a big tightening in the middle part of 2020, but by the end of the year, the tightening had really started to fall off. Banks are comfortable. They haven't seen big losses, and they're willing to go out there and start lending again. All this suggests it's not going to be anywhere near as bad of a cycle as we saw the last time around. Now, despite the fact that commercial real estate is cooling, you would notice that in prices for construction goods. Indeed, we saw a big spike in the prices, particularly for lumber, towards the end of last year. What's driving that, of course, was the housing market. And yet again, some of the crazy predictions you heard about housing, we're going to see falling home prices, we're going to see massive foreclosures, you could see a major meltdown. None of those things happened. Quite the opposite. We had a couple months of a very cold market, and by the second half of the year, the housing market took off like we have not seen since, of course, the heady days of that subprime mortgage bubble prior to the Great Recession. Overall existing home sales surged towards 6 million units at a national level. That's seasonally adjusted annualized. Home prices, which have been lagging at about 2.5% last year when I saw you, accelerated to about 10% on a year-over-year basis. Crazy numbers. And of course, with all this demand for housing, single-family housing starts are up, new home sales are up, builders are incredibly optimistic according to the confidence surveys for that part of the economy here. What is going on? And here in California, even more so. Remember, we entered into this pandemic with a problem in housing. Not that housing was too affordable, but that we didn't have enough of housing. We had a major supply crisis, and that in turn was leading to, of course, higher prices. Now we came into this pandemic, housing demand took off in the context of a very, very supply-constrained market, and the market here is absolutely just popping like we haven't seen. Month's supply of inventory right now is down to below where it was in the midst of the highest point of frenzy in that pre-Great Recession type market. It's crazy. Home prices at the state, which had leveled off at about 600,000, popped to 700,000 in just the last couple months here in California. Down here in the southern part of the state, Orange County prices have jumped up. They're getting close to a median of 900,000. LA County getting close to 750,000. Again, the markets are going up, up, up. What is going on? Why did, of course, the market turn around completely? Well, there's a bunch of different things happening here at once, and let me just kind of pull together a few of the threads for you. First of all, we know the pandemic itself. Well, people were stuck at home, and when you're stuck at home, you realize just how small your home is. We also, of course, had a number of people who maybe have been living in San Francisco or maybe living in downtown LA. There was no point in living in those urban environments, and they wanted to move out into the suburbs to not be in that urban environment. That drove things. But then you have to layer on what I would call the short-run considerations or the long-run consideration. The reason the housing market was soft in the lead up to the pandemic was because changes in tax laws that, of course, limited how much you could write off from your taxes in the form of interest payments. Equivalently, we also had, of course, the change in that same change when it came to property taxes. And last but not least, we were dealing with rising interest rates. All those forces created a temporary lull in the market, a lull, by the way, that went away coming into 2020, because we've now priced in those tax changes, and more importantly, interest rates came way down. The net result of that, of course, is you saw a huge surge of people wanting to get into homes, a big bounce in home ownership rates through 2020. I know it looks a little bit volatile there, but by the end of the year, we ended up a little bit below 66%, which is significantly more than we were just a couple years ago. The market is absolutely on fire. Is it a bubble? There, I can say no, not yet. It could turn into one, but we got a couple of years before we start worrying about that. The reason I'm not worried about it is because, remember, when you think about the word bubble, you're talking about people overextending themselves, getting involved in too much housing, taking on financial risks they really can't afford to take on. We're not seeing any of that. Indeed, the past bunch of years have seen really modest increases in overall mortgage debt with falling interest rates. One result of that is mortgage payments as a percent of disposable personal income in the U.S. economy coming into the pandemic were already a record low level. Now with these record low interest rates, people refinancing as well as buying new homes, that number has dropped to even lower. Indeed, the share of disposable income being spent coming into the second half of 2020, we're talking less than 4%, lower than it has ever been. That is not a housing market that is in any way, shape, or form bubbly. And of course, as already noted, mortgage markets are super clean right now. There's not going to be any foreclosure wave at this particular point in time, no doubt about it. As for residential permits, could have been a very ugly year last year. The good news was it didn't actually happen. Permits weren't up, but they weren't down much either. Indeed, Orange County, they cooled off a bit, but that's only after the hot 2019, and LA continues the same sort of downward trend. Now, by the way, that's good news that we didn't see a meltdown, but let's also remember the big problem we have is we need a lot more housing than what we're currently constructing, even if we remained at trend. As for apartment markets themselves, not quite the same good news. You did see multifamily housing start to go down, you saw rents start to come down, vacancy rates start to drift up, but this is not being driven by what you might think. The big story out there is the problem here, of course, is that millions of renters don't have any money and they're all on the verge of being evicted. Indeed, you've probably seen plenty of scary headlines that would suggest that millions of people, 30 to 40 million by some estimates, people are at risk of being evicted right now. Now, I can tell you, this is not true. It's as simple as that. This is completely false. And the reason you're seeing these crazy headlines is a combination of the miserableism we already talked about with a almost deliberate misinterpretation of the pulse survey that the census put into place at the beginning of this pandemic. Now, the pulse survey was a nice idea. Let's get a feel for what's happening out there. But they asked a lot of vague questions. And one of the vague questions they asked was, are you having trouble paying your rent? Now, the reason I say that's vague is because everybody's interpretation of what trouble is may differ. For some folks, trouble may mean I have to give up getting a prescription medication. We can understand that. But for somebody else, trouble may mean I can't have my 3 Frappuccinos from Starbucks that I typically have every morning. We don't know. And more importantly, we don't have any way of gauging what that number would have looked like pre-pandemic since they started the Pulse survey in March. In other words, we don't have any pre-pandemic numbers to compare this against. What I can tell you is that data from the National Multifamily Housing Council doesn't present anything close to as negative a picture of the apartment markets. Their numbers suggest coming into this particular year, only about 3 percentage points of renters are having trouble paying the rent this year relative to last year. In other words, the number of renters who paid up at this particular point in time last year was 96%. This year it's a little over 93%. It is not the meltdown we're hearing about. Simple as that. Now, the rental markets are having a problem, but it is an absorption problem. What you have out there is a lot of apartment buildings coming online, particularly in some of those downtown areas, and people aren't moving downtown right now for all the obvious reasons. As a result of that, they're cutting rents, trying to get people moving into those products, and it's just taken some time. That is not a major market meltdown, and it's amazing to me how much time state and, of course, local and now federal authorities have spent talking about eviction moratoriums, despite the fact that there's not a shred of evidence that evictions are anything close to the problem they have been presented at. Again, it's an interesting time we live in, to say the least. Coming into Orange County, again, a very similar sort of picture. Rents have come down a bit. Again, it's mainly those who put new apartment buildings online, trying to get people to move in. Vacancy rate's still a very, very tight 4%. Remember, the big problem in California is we don't have enough housing. You're not going to have a multifamily meltdown in that kind of marketplace. You're just not. And indeed, the biggest issue we have out there is not enough housing. My problem with this pandemic is we're so focused on passing eviction moratoriums that we've forgotten about getting policies into place to expand the housing supply necessary to meet the needs of really California residents. As simple as that. And that, of course, has a lot to do with the still ongoing migration of people out of California into the rest of the country. Indeed, here's the data from 2020, hot off the presses. California, in absolute terms, saw the greatest number of people move out. In percentage terms, we were 6th worst in the nation. Again, this is not business climate. It's not taxes. It's a simple fact that we don't have enough housing. You want California to be able to grow. The answer is housing, housing, housing. No more, no less. That is what the conversation has to be about. And again, this pandemic has dangerously distracted us from that incredibly necessary long-run goal. Just as simple as that. Now, with all the good news I just gave you, the one thing I haven't talked about is employment. I've saved that to last. And I did that on purpose because when you think about the negative conversations about our economy, it is largely about the employment markets, because there's little doubt that there are a lot of workers still out of work right now. But yet again, if you dig a little deeper into the data, you find out that while we have to worry about those workers who are still unemployed, who still aren't bringing income back to their families, at the same time, the aggregate situation, the macro situation, is nowhere near as bad as what the rhetoric would have you believe. Let's start with the basic idea here, okay? That right now, we have about 9 million fewer jobs than we did pre-pandemic. That's a big number, about 6% overall. Most of that really is in 2 sectors. Leisure and hospitality, again, that's restaurants and entertainment and recreation, hotels. The second part of that is government. That is mainly local education. Schools aren't open, and as a result of that, a lot of the auxiliary workers who are hired, whether it's janitors or teacher aides, they too are not working. This is about half of it. Now again, the reason this is relatively good news is come back to the idea that we're getting control over the pandemic. Disneyland's getting ready to be open. Restrictions are coming off restaurants. We have plans to reopen public school districts. In other words, these jobs are about to come back online very, very quickly. That's relatively good news. And the reason, again, I think people got it so wrong at the beginning of this, the reason they panicked so much, is we saw that unemployment rate hit close to 15% at the beginning of this thing. And everybody freaked out because history shows us that when unemployment goes up, it takes a long time to come down. Hence the panic in that particular number. But even as I mentioned last year, that number is not what it seems. Most of the people who were unemployed at the beginning of this thing were not truly unemployed. That is to say, they didn't have a job. Rather, they had a job, they just couldn't go to it. They were on temporary layoff. That number, temporary layoff, surged to 12% of the labor force. We've never seen anything like that. The highest this number has ever been in the history of the United States is a little above 1%, and it went to 12% last year. Now it has dropped, it's now below 2%, which, by the way, is still a significant portion of those who are currently unemployed. A lot of these people are just waiting for the job to come back online, and they know exactly what they're going to do once we get this pandemic is truly in front of us, truly behind us, excuse me. Now, at the same time, there are a rising number of people who don't have job prospects, whether that temporary layoff turned into a permanent layoff, or they're a worker who just needs to find a job for whatever reason. That number right now is running about 5%. Now, 5% is not a big number. And again, when you think about this from an aggregate standpoint, during the incredibly bad Great Recession, that number was 9%. And of course, during the very mild tech recession, it was 5.5%. So what you would say is this enormous shock to the U.S. economy created a mild recession in its wake. And again, you can see it on the right-hand side. This is what I call, because they always love to throw these numbers around. Millions of people are unemployed right now. That's true. Guess what? In the midst of the tightest labor market prior to the pandemic, right, when we had a 3.5% unemployment rate in the U.S., there were millions of people unemployed. There are always millions of people unemployed in the U.S. That is just frictional unemployment. It's always in place. Economists long ago acknowledged that the unemployment rate will never be zero. That is just the nature of things. Now, if you take that frictional unemployment out, but you also add in the underemployed, maybe people who don't have as many hours as they are, that's on the right-hand side. It's the cyclically excess U6 as a percent of labor force. Again, during the Great Recession, that got to 10%. This is the expanded version. And right now, it's below 5%. So from this perspective, yet again, things don't look nearly as dramatically bad as the press would have you, as you have you believe. There's no doubt that there are workers on the outside getting hurt, but we have systems to help them. It's called unemployment insurance. And one of the good things about the package that got passed is they will continue to expand that particular safety net. Other things to think about. You've heard a lot about the K-shaped recovery, which I just love this. Somebody comes up with this cool idea, K-shaped recovery. That means low-skilled workers are not doing as well as high-skilled workers. For the record, every single recovery from every single recession in the history of the United States had a K-shaped recovery. That's the nature of how our business cycles work. Here's the good news. Unemployment for people with a high school degree went way more than it did with people with bachelor degrees. By the way, they're both coming down at the same rate. And go back to the idea of a winner-loser type economy. Take a look at the right-hand side of the screen. This is job openings in the U.S. economy. Amazingly, right now, job openings are just a little bit below where they were pre-pandemic. Pre-pandemic, they were a little over 7 million, now they're a little under 7 million. Still plenty of job opportunity out there for people. Remember, we came into the pandemic with a big problem being labor shortages. That again suggests that those who are on the outside will be able to get reintegrated in the labor market relatively quick. Another thing to consider, again, you've got to worry about those workers who don't have a job right now, who aren't earning income. We have to give them some sort of safety net till they can go back to their job. But at the same time, again, unlike the Great Recession where pretty much everybody took a hit to their income, even if you kept your job, this time around, because of that winner-loser aspect of things, while there are those on the outside who are obviously being economically harmed, those on the inside have actually seen their prospects increase. They get better off. Because you think about your typical worker at Home Depot who's working 15, 20% more hours than they did last year at this point in time because it is so busy there. The net result of that is the median usual weekly earnings for people has surged in the midst of this particular pandemic. And while it is true that overall jobs are down 6% below where they were pre-pandemic, incomes for those who are working, earned incomes, are where they were pre-pandemic. So in other words, for those who are on the outside who aren't working, their loss of income has been made up by everybody who's continued to work from an aggregate standpoint. Again, worry about those workers who are still unemployed, But from a macroeconomic perspective, you can see here that the damage is nowhere near as intense as some of those stories would have you believe. And that's a very similar picture here in Orange County. The numbers, of course, are still way down. You're talking about a 9% decline in employment relative to pre-pandemic here in the county, about 147,000 jobs. But the vast majority of those lost jobs are in hospitality and, of course, local government. That's the big source of the problems here, like many other parts of the United States right now. Yes, Orange County has done worse in places like Phoenix, but better than Vegas. Again, it's that fly-in tourism aspect of things that's driving the particular show on this. But better news comes from the idea that you've seen some stability in the labor market, labor forces come back, and of course the unemployment rate here in Orange County is actually significantly below 10% at this particular point in time. Now, I'm not looking too much at the employment data because we're just a few days away from the big revision for last year. I don't really trust any of these numbers until they get them all revised, which we'll see when the January 2021 numbers come out. Keep an eye out. It's going to be interesting to see what those numbers tell us. What about small businesses? We're hearing about the small business Armageddon, right? There's no doubt about it. You came into the end of 2020, 36% of small businesses here in the state of California were still closed at the end of the year. What people don't talk about is in the second half of 2020, there was an enormous surge in business applications. What you see there, of course, is a lot of entrepreneurs who are going, look, I'm not going to be able to pay 8 months in back rent. Why should I? I'm going to close down my restaurant. I'm going to close down my personal care store, but I'm going to reopen a new one. And you know, as opposed to panicking about the businesses that aren't going to reopen, let's make sure these entrepreneurs have the resources necessary to get that new restaurant, to get that new nail salon reopened at the back end of this thing. Because again, there are a lot of folks out there getting ready for the next expansion. Now, will there be a next expansion? What's that going to look like? Is that going to be weak, coming out of the starting gate the way we saw during the Great Recession? Absolutely not. For some of the reasons I told you, that this is nowhere near as dramatic as the Great Recession, but also because of the excessive degree of monetary and fiscal policy. Now, some of what they did was good. There's no doubt about it. And I applaud Congress for getting ahead of the curve. You know, they dallied around way too long in the Great Recession before they did anything. And by then, of course, a lot of damage had already been done. This time they acted very, very quickly, but it was too much. Again, the conversation about miserabilism was excessive. It panicked our government into the point of doing just too much. And some really odd things when you think about it from kind of a logical standpoint. So, right off the bat, number one, unemployment insurance. They expanded who could get it and how much they could get. Brilliant. Absolutely what you wanted to do. That is the automatic safety net. That is there to catch those people who obviously have lost their jobs and give them the support they need till they go back to work. And to be clear, a lot of people are getting this money. You're talking about 20 million people are still getting checks from various types of programs in the United States economy. Very, very good. Local government support, particularly for, say, hospitals or airports, I'm fine with that as well. But then we started getting into some of the odd things. Because remember, this was a $2.4 trillion plan, an enormous amount of money to throw at the economy. And when they decided to throw this much money at the economy, you know, hey, when you have that much money to spread around, when you're just fire hosing it, who cares? Just throw it out there. So the PPP loans, again, sounds good on paper. Let's give businesses money so they don't lay off their people. But the choice of laying off somebody isn't based on a couple months of payroll. Companies are not that close to the bone, typically speaking. They have some space. They have a little wherewithal. And after all, businesses don't want to lay off employees. It's incredibly expensive to send somebody home. From a morale standpoint, from a business cost standpoint, from the loss of business human capital standpoint. You don't make those decisions, and it's hard for me to think that giving somebody a couple months of payroll is going to make a big difference. It just doesn't make a lot of sense. And then you figured out how they did it. Did they actually tailor the program to those who truly needed it? No. It was whoever called their accountant first, which yet again begs the question, what are you actually trying to accomplish? And then you had the direct transfers to people, the checks. First time around $1,200, then $600, now it's another $1,400. We're going to come back to this in just a second, but that doesn't make any sense. Remember, the big problem we have in the pandemic is people can't spend money. Why are you giving people money when they can't spend the money? That's not helping the economy. It's just helping that person pay off some of their debt. That's not what these programs are about. They're supposed to support the economy in the short run. And then the monetary stimulus as well. Jerome Powell is pretending he's Ben Bernanke. He's not. What Ben Bernanke was facing was completely different than what Jerome Powell was facing. Yet he's using the same playbook that Ben Bernanke did unwisely, with, again, potential repercussions. Now, what do I mean by this? Now, let's talk again about unemployment. As already noted, coming into the beginning of this year, 20 million people are still getting checks of various sorts from these various programs. There may be a little overlap here. I'm not sure what the net number is, but a lot of people are getting that. And we should be happy about that. That is the automatic support system there to help these folks until their job comes back. But then the PPP loans. 1% of PPP borrowers captured 25% of that money. 25%. That's a $3 to $4 million average loan size. Which, by the way, if you're big enough that basically, you think about that, at $4 million, that means 2 months of payroll is $4 million. That's $2 million of payroll per month. That's not a small company. And it certainly isn't a local restaurant. It certainly isn't a personal care. I don't know what it is, but it's clearly not going to the type of businesses that need it. If you have a payroll of $4 million for 2 months, you can go to a bank and get a short-run loan. You have that access to credit. But those folks got a ton of this money for what? It basically passed through the owners of those companies. Wasn't actually needed. Not sure it was all that wise. And of course, those direct payments to households, as already noted, sure, some of these households needed it. Remember, we think about last year, you're talking about maybe 10 million people who really saw some degree of hit to their income. But 150 million people got those checks. For the other 140 million people, they didn't need the money. Their problem was that they couldn't spend money. They couldn't go to a restaurant. They can't go to Disneyland. Giving them money they can't spend, what do you do with it? You pay down your debt. You save it. 70% of the first direct checks mailed to people went into saving or paying down debt. Now, mind you, remember what I showed you before about, say, for example, mortgage debt? Mortgage debt is a percent of disposable income, the lowest it's ever been. Overall debt, the cost of debt as relative to people's incomes, the lowest it's ever been. We are not a debt-constrained society. Yet what we've done is taken advantage of this pandemic to basically enrich ourselves. Hey, give us more free money. I'm going to pay down my debt. I'm going to stick it in my savings account, and I'm going to leave that debt for my children and grandchildren to pay back. Because you know what? This isn't free money. All the money we're getting is being backed up by the issuance of government debt. This is not stimulus. This is an intergenerational mugging. We are already an incredibly rich generation, and here we are making ourselves richer on the back of our children and our great-children and our great-grandchildren. It's unbelievable, and yet there's no conversation about this at all, at all. And by the way, they're already doing studies that show that 80% of people getting this next check are going to do the same thing. They're going to save it. That's not what this money is for. It's helping very few of the people who are getting it, and it's not stimulating short-run economic activity. How over the top was the stimulus? Take a look at these numbers here. On the left-hand side here, this is overall incomes, outlays, earned incomes, outlays, and then, of course, government benefits. Incomes dropped, no doubt about it, not as much as you might think. Outlays dropped more so. In other words, even as bad as this economy was, you actually would have seen a surge of savings because, again, incomes got hit less badly than spending did. So there are always going to be increase in spending. But then for every dollar of lost income, the government put back $2, 2 to 1. Now, where does that money go? Well, it goes right into savings. In 2019, in aggregate, all households saved $1.2 trillion. In 2020, $2.9 trillion. $1.7 trillion in excess savings. $1.7 trillion with a T. That is a crazy amount of money that we have built up, again, through the issuance of government debt. One of the things, again, this is good news, all that money's sitting there getting ready to spend. The American Society for Travel Advisors did a survey last September, And pent-up travel demand back then was at an all-time high. And everybody said, what are you going to do when the pandemic goes away? I'm going to travel. They're going to come to Disneyland. There's tons of money to support that. So it's going to be famine to feast. As soon as this thing cools down, it's never going to be busier in these fly-in tourist resorts. Everybody's going to be spending his money. It's great. It's fantastic. It's an incredibly rapid recovery. Prepare for acceleration. The downside, $3 trillion in federal debt last year, probably $4 trillion this year. $7 trillion of new government debt in 2 years. 35% of American GDP in 2 years. We've never seen anything like this before, ever in the history. We didn't borrow anywhere close to this percentage of GDP in the middle of World War II. What are we doing? And keep in mind, folks, this is not happening in a vacuum. 2 years ago, had we had this conversation, I would have told you how we were 15 years away from a massive federal debt crisis because we can't afford Medicare and Social Security in their current form. And here we are, borrowing like a sailor on a short shore leave, bringing that day of reckoning forward to us. It is the most unbelievably irresponsible thing I've ever seen as an economist, and there's no conversation about it. It's very, very odd. But as bad as the situation at the federal level, here's a place that's not bad, state level. Remember last year, Gavin Newsom told us we were going to have a $54 billion deficit? Even the pessimists chuckled at that number. By the way, right now they're talking about a $30 to $40 billion surplus for this particular fiscal year. That's not a surplus. That just is surplus relative to the ridiculously low estimate they had. Indeed, current numbers suggest we're up 1% from where we were last year in the state of California. There is no budget crisis in this state. There is at the local level, there's no doubt about it. The state should be less worried about its financial problems and spending a little bit more time helping the counties and cities who have been impacted getting forward on this particular situation. And then, of course, the Federal Reserve. Again, taking a page right out of the playbook of Janet Yellen and Ben Bernanke, Powell opened up the quantitative easing spigot. And you're talking trillions of dollars in quantitative easing in the first couple weeks of this situation. By the way, as much as Janet Yellen and Ben Bernanke did in combination with each other over a 6-year period. He's not the only one. The European Central Bank did it as well. The English Central Bank did it. It's a global phenomenon. But why? Look, when you think about the Great Recession, Ben Bernanke and Janet Yellen had a huge problem on their hand. They were fighting the collapse in wealth, the collapse in the housing market, a financial system that had been absolutely pummeled with loan losses. That was a huge deflationary problem. You had to get tons of money into the system. We're not seeing any of that. Household wealth is increasing right now because the housing market's on fire, because people are paying down their debt with stimulus money. And of course, let's not remember that the stock market is hitting all-time high level. Are there problems in the debt markets? Look for yourself. This is data through the fourth quarter of the year for consumer debt. Delinquencies in all kinds of consumer debt are down, not up. What war is he fighting? Not the last one, but he thinks he is. Now, the banking system, same sort of picture. Do they have any major problems with their loans? No. The right-hand side here, commercial bank delinquencies look incredibly low at this point in time. No major issues there. And by the way, banks have a lot of largesse right now. They're certainly not seeing a loss of deposits. $2.5 trillion in excess bank deposits since the start of the pandemic. $2.5 trillion. That's the business deposits as well as the household deposits. Massive amounts of money. Banking system's fine. What are you doing? Well, I can tell one thing he's doing. He's setting the financial markets on fire. The PE ratio for the stock market, third highest PE ratio in the history of the United States. You seen Bitcoin lately? A little frothy, huh? Hey, you look at Robinhood and what happened with the GameStop and so on and so forth. When you have this much money floating around the system, it's no surprise at all that you see financial markets, asset markets, do the kind of crazy things they're doing right now. Again, this is potentially destabilizing. Financial market volatility, whether it's positive or negative, creates dangerous turbulence in our economy, things we all have to pay attention to. And look, interest rates have been coming up lately. Inflation's been heating up. But to be clear, this is not any sign of that excess liquidity Excess liquidity will turn into inflation, which will turn into higher interest rates, but that's going to take a little while. This is just a return to normalcy. I mean, look, we came into the pandemic with bond rates around 2%. Why did we think they were going to stay below 1%? Of course they're going to go back to 2%. Look how strong the expansion is. And as for inflation, again, there was a brief cooling off period, but now it's getting back to normal levels. Gas prices are getting back to normal, so on and so forth. This is recovery, not what I would call a new phase. But with all that money out there, the potential for inflation and hence even higher interest rates is absolutely real. And I appreciate that a lot of economists have kind of poo-pooed the inflation situation. I mean, after all, we haven't seen any inflation for the past 20, 30 years. Clearly, the Federal Reserve has it figured out. Yes and no. Nobody really has inflation figured out. And I have to appreciate that the economy operates different today than it did in the 1970s, the last time we had a big inflation surge. When you think about these numbers, again, this is a return to normalcy, not what I would call the beginning of a new inflationary surge in the U.S. economy. But the potential for inflation is higher than it's been in the 25 years since I've been doing the kind of forecast game. Take a look at the left-hand side here. This is a little bit wonky, but it's what we call unit money supply. It's M2 divided by nominal GDP. It's kind of a measure, if you will, of how much money is floating around the system relative to the amount of economic transactions going on. And the reason this is relevant is when unit money supply becomes high, that is inflationary. Now, one of the reasons so many economists are relatively unworried about inflation is the fact that really since starting about 1999, 1998, you've seen a steady increase in unit money supply, and yet you haven't had any inflationary pressures. Now, I appreciate that would suggest that this is not the same kind of economy we had back in the 1970s, the last time we saw inflation kick in. But I'd also point out the massive degree of quantitative easing, the massive degree in bank deposits has pushed unit money supply to a level we've never seen before. It's increased it, something on the order of 30%. Now, we are way outside the realm of experience on this front, and that means we are in uncharted waters. And to say this isn't potentially inflationary, well, that's simply not a realistic thing to be suggesting. Simple as that. We just don't know. So the next couple of years, you have to keep an eye out for it because, well, think about what happened in the late 70s. You know, in the 70s, we had a supply shock driven by the OPEC oil embargoes. And as a result of that, back then, we overstimulated the economy. And of course, that caused the big inflation surges we saw towards the end of the 1970s, which in turn created, remember, 14% mortgage rates, 15% mortgage rates, so on and so forth. Now, I'm not saying we're going there yet. We got a long space between here and there. But we're absolutely pursuing that kind of policy. And if we do, well, you may very well be seeing the seeds of the next recession being sown. Because remember, that high inflation part of the 1970s eventually turned into the Volcker inflating, fighting efforts of the early 1980s, which of course set off what was at that point in time the worst recession in the post-World War II period. So keep an eye out. We're just not sure what this is going to look like. So what about the long run? What are we expecting here? Now, as noted at the beginning of this, you heard all sorts of things about new normals, how the whole world was going to change and people were not going to be going to baseball stadiums or theaters ever again because they're going to be afraid. Well, look, epidemics have been with humanity since the dawn of civilization. The idea that this time around it's going to scar us seems at best trite, to say the least. And indeed, anecdotally, anytime a beach was open or indeed the kind of whack-a-mole game that public health officials were playing with, whether it was underground clubs popping up or kids having big parties, it's clear that people were already chomping at the bit and wanted to go out and live their lives, even in the midst of the worst parts of the pandemic that was around us. Now, with that in mind, while I'm not worried so much about people changing their behavior, it's absolutely accelerating some of the underlying trends we've seen in our economy over the past 10 years. First and foremost, the movement towards, of course, online sales. There was a big jump, of course, in internet sales at the beginning of this thing. A lot of seniors learned how to buy their toilet paper online, and as a result of that, of course, the internet has picked up a bunch of new sales, and they're not going to let those go. We've seen this in the past. You're accelerating the trend towards online sales. Now, what does this mean for, of course, California? What does it mean for the United States? Well, it means we need to start getting in front of a problem we've had for a long time, which is too much retail space. Take a look at these numbers here. This is retail space square feet per capita. And the United States and Canada has vastly more than almost any other developed nation out there. We have too much space. It's no longer needed or necessary. We need to figure out what to do with this land. And that's particularly important here in California because so many local governments rely on retail space to fund their local government through taxable sales. That's not going to be available to them. So it's contingent on the state and local land use planners to get in front of this, both in terms of thinking about how do we de-retail, what do we do with this land. By the way, I have a simple suggestion. How about the state pass a law that says all retail is hereby and hereforth mixed use, retail, residential? Think about it. Big solution there, never going to happen. But clearly, that would be one thing you could do. But in general, we have to get in front of this. And it isn't just what do we do with that land that we don't need anymore in retail for zoning, but also how does the state help these local governments backfill? If you're not going to have that shopping mall, if you're not going to have that corner plaza, how can you earn the cash you need to keep the streets paved and the water supply running? That's a conversation that needs to be had. The sooner we have it, the better. And then, of course, what about work from home? Now, again, I think the work from home thing has been overstated. A lot of folks have been talking about how businesses aren't even going to have office space anymore. Well, I think that's extreme. But it is fair to say that, in the midst of this pandemic, about 25% of all work days were being worked from home. 25% is a big number. And according to a survey of employers, it will only come down part of the way back to where it was before the pandemic, which was about 5 work days. It'd be about 14.6 is what they're thinking of. That's according to these surveys. So yes, people are going to work from home more often. Now again, it's not going to be the end of the office. Here's a survey that was done, interestingly enough, in 2020, where they asked people, well, how many days would you like to work from home? Now this is still at the beginning of things, some of these folks, so maybe they weren't quite sick of it yet. But even then, only 27% of people said they'd like to work from home all the time. 33% said rarely, if never. By the way, those 33% almost assuredly had kids at home. Just saying. Putting that to one side, of course, what you're talking about here is a situation where you can't close your office. And, most corporate executives have already acknowledged this. The few tech companies that said maybe we're going to go all virtual have been faced with almost a mutiny of their folks because people don't want to be isolated. They want to be around their friends. They want to be around their coworkers. They want to go out for lunch. They don't want to be stuck at home. However, there's no doubt that most companies, including mine, will probably move towards letting people work from home a couple days per week. And that, of course, brings me to the concept of downtown. Now, we heard downtowns are dead, right? We're all going to work remotely. Everybody's going to be afraid of being around each other. Ergo, if you're thinking about downtown Irvine or downtown San Francisco or downtown Manhattan, forget it, they're dead. It's passé. No, that's not going to happen. In economics, there's always been this kind of interesting question. Why are there downtowns? We all know that when you have a very dense area of jobs and often residents, you have traffic problems, you have to build tall buildings, which are incredibly expensive, which means rents are higher. So economists have to ask yourself, if you have these higher costs, why do downtowns form? And the answer is because what economists refer to as external economies of scale. The idea here is your business is more efficient when you are in a dense job region. You can find employees better, you can find vendors better, you can find clients better. It's easier to deal with employees, vendors, and clients. And of course, there's a panache to being in one of these high-end buildings. Now, if you think about downtowns as being this kind of force between the increasing cost versus the increasing value of being downtown, what happens when suddenly you have less square foot per person? Because that's what's going to happen. You're going to have, maybe before you had 30 square feet per employee, you're going to go to 15 or 20 feet per employee because some of your folks are going to be working from home a couple days a week. Now what that means is less demand overall for office space, which means reduced costs in those center areas, which is going to pull more jobs in. Look for increasing densification. Look for more companies moving downtown because they can because of these reduced costs. So this is not the end of downtowns. Indeed, I would argue downtowns are going to become more important than ever. And as for people who work at those companies, well, you're going to have choices. You could live downtown and enjoy that hip urban lifestyle, be close to work, or you could be in the suburbs. Sure, you face a commute, won't be as bad as it was before because you can work from home a couple days a week, or perhaps you're that employee who'd rather be in a nice house up in the Sierra foothills. You'll do that too, and then a few days every couple weeks you'll come into the office to do the things you need to do in person. So overall, it says, of course, that you're going to see more specialization from a residential standpoint, but more aggregation in the point of these downtowns. Downtowns are going to be better off as a result of the situation. And of course, as for biz travel itself, when you think about conventions, when you think about going on that sales meeting, look, we all know, of course, that any kind of meeting that could be done via Zoom almost surely will be because, hey, it's efficient, it's easier. We have the systems in place. We know how to operate. It's become built into our business culture. But at the same time, we've also learned how important face-to-face is. Look, it's nice that I'm here talking to you in this virtual type world, but I'd much rather be in front of you right now so I can see your eyes and talk to you and you can ask your questions in real time as we go through all this incredibly important material. It's better to be impertinent. And you know, it's interesting. A survey was done not too long ago. Over half, 58% of business travelers express the fact that they are burned out by virtual meetings. They want to be in person again. Simple as that. And there's another great quote that came out of this. Business travelers expect that conferences, conventions, and trade shows will be offered in virtual hybrid format, almost assuredly the case, but the majority, 77%, said, I'd rather be there. Because we know the fun is getting the tchotchke in the exhibition hall, having the couple beers with an old friend at the bar. That is why you go to these events. Let's just face it, folks. Let's say it out loud. We like conventions because they're fun. That hasn't gone anywhere. In fact, you come out of this, people are desperate for fun. The convention business, again, is going to take off like nobody's business. At the back end of that, it's going to lag. It's going to be 2020. But again, it's come back. So, wrapping it all up, where are we? A lot of material there, but let me sum it up this way. This wasn't good. It was a natural disaster, tragic consequences. 500,000 people plus here in the United States have lost their lives as a result of COVID. I get it. Our heart has to go out to those folks. Our heart has to go out to the business people and the workers who continue to wait for their businesses to be able to reopen as these vaccines get rolled out. But with that in mind, it's not that bad. It's not the existential threat it has been sold to us as. And I mean that not only from the point of view of the economy, the V was the only natural outcome, and we are in the midst of a V. It stalled out in the last quarter of last year because of the huge surge in new cases. That was all it was, a stall. The V is coming back hard this year, and we're going to be back to normality almost assuredly by the beginning of 2022. It's also not that bad in as much as the pandemic itself wasn't that bad. You know, there are a lot of comparisons to this situation to the Spanish flu. But mind you, the Spanish flu killed over 50 million people worldwide. Now, when you compare that to the number of deaths this time around, and then you contrast that to the population of the globe back then and now, what you quickly realize is the Spanish flu was 100 times more deadly than COVID-19. 100 times, folks. So our hearts have to go out to those people who've lost loved ones, but we also have to go, we got lucky. This could have been way worse, and I hope next time around we're a lot smarter about how to deal with these situations when they arise, because it will happen again. Baseline forecast, we're going to see 5.5 in Q1, and then we're picking up. You know, I have 7% for Q2. I'm actually thinking it's going to be in the 10 to 11% range, and then it'll cool off in the beginning of 2022 as we get back to long run, what I would call trends. And we could be entering into, again, what I call the new roaring 20s. Remember, the last 20s were a period of incredible growth, but growth that was in part pushed on by huge financial bubbles. This could be the next roaring 20s, in as much as the phenomenal over monetary and fiscal stimulus of our economy could be creating the kind of bubbles that will make the next few years really, really aggressive in terms of growth. You're going to be making money. You're going to be busy. A lot of things are going to be going on. But is there a collapse? Is there a pop? Is there an inevitable, shall we say, return to normality out there that we all have to be worried about? Pay attention to it. You know, I like to say it this way. Enjoy the party, but make sure you leave before the police show up. As for our true enemy, of course, it is miserableism, our inability to talk about the economy in any logical, data-driven way. It was a problem prior to the pandemic. It was a bigger problem in the pandemic. It was directly responsible for the excessive fiscal and monetary stimulus we've been dealing with. So again, something to think about. That hasn't gone away. We're not paying attention to the next generation. Our politics are still extreme and out of touch, and it's leaving us with an incredibly dangerous political vacuum in the important places where policy needs to be set. It worries me. It worries me a lot. Now, there's always some wild cards. Will there be a new variant of virus that is truly resistant to the vaccine? I don't think so, but you have to keep an eye on it. Again, you got to keep out for that financial bubble. You got to keep an eye on interest rates and public debt and everything else. The problems are out there. Most of those problems are largely of our own making because, again, of our inability to take the data and understand what it means and to put aside the crazy rhetoric we hear from our politicians or we see on Facebook. You know, we have proven the resilience of the U.S. economy. We've proven the strength of our scientific community that got these vaccines created in an insanely fast amount of time. We got lucky from the number of people who could have been killed by this terrible disease. But instead of acknowledging the strength of the economy, how lucky we've been, and how good things are, we continue to foster this conversation of decline, this conversation of brittleness, this conversation about an American public who's starving on their feet when it's pretty obvious they're not. Take a step back, let the data talk, and you realize, again, it's going to be a good year in front of us. And indeed, our economy has persevered magnificently, even in the face of this substantial challenge. Whew, that was a lot of material. I know we're going to have a little bit of Q&A, so what we're going to do right now is take a break for our sponsors, and when we come back, let's go through a little bit of this and see what kind of questions I can answer.
Hi, I'm Supervisor Lisa Bartlett, representing the fabulous 5th District in South Orange County. We live in a suburban paradise with burgeoning economic activity. From healthcare and retail to tourism and technology, South Orange County is becoming a hub for the 21st century workforce. There's no doubt that 2020 was a very challenging year for our economy, especially our small business community. During COVID, one of my top priorities was to ensure that businesses struggling to stay afloat had access to much-needed financial relief. Utilizing a combination of county and federal CARES Act funding, I was very pleased to offer 2 small business grant relief programs totaling more than $16 million to support local businesses within my district. As we emerge from this global pandemic, I'm confident that the business community in South Orange County will lead the way in our economic recovery. I'm proud to support the 2021 South Orange County Economic Report and look forward to hearing Dr. Thornberg's forecast of our economic future.
When you have wall-to-wall Wi-Fi throughout your whole home, you can use it everywhere. Yes, even there. Get wall-to-wall Wi-Fi with Cox Panoramic Wi-Fi.
Powering San Diego's future. We are transforming the utility industry with innovations like state-of-the-art battery storage, expanded EV charging, and cutting-edge microgrids. We are trailblazing new pathways like green hydrogen and other technologies to harvest excess solar. We are SDG&E.
Did you know almost 2 out of 3 American jobs are created by small business? And 9 out of 10 companies have fewer than 20 employees. Our local dry cleaners, hair salons, florists, coffee shops, and restaurants, they need your support now more than ever. As the leading business advocate in the region, the South Orange County Economic Coalition encourages you to shop local to protect our hometown businesses. For our jobs, for our neighbors, for our community. Shop local. Welcome back. If you are just joining us, I am Steve Lamont, Chair of the South Orange County Economic Coalition. Today's program could not have happened without the generous contributions of our sponsors, including our title sponsor, UCI and UCI Health, as well as our presenting sponsor, our Orange County supervisor who represents all of South Orange County in the 5th District, Lisa Bartlett. I am joined by Dr. Chris Thornberg of Beacon Economics, who just shared a very informative overview of our economy. So, Dr. Thornberg, welcome. Thank you. I can't believe it's been a year since we sat down for the 2020 virtual economic report. And so a lot has happened. You went over a lot today. I had a lot of questions, but you answered a lot of those questions. So that's good. So good for you. Thank you. It is a lot of data. We do have some questions that we still want to go over, but I want to start with, has there anything that has happened that has been a surprise to you and trends you did not see coming?
Well, I would not have anticipated the crazy, excessive degree of monetary and fiscal stimulus. That really surprised me, particularly the passage of this last $2 trillion, $1.9 trillion plan that's currently working its way through Congress.
Sure.
Again, look at the numbers. Look where the economy is. Look how unemployment has come down.
Yeah.
And they're going to pass one more stimulus plan that is larger than the entire stimulus plans put into place for the Great Recession. And you ask, what are we thinking? Have we completely forgotten about tomorrow, about the next generation? That worries me. It really worries me. And it says so much about where we are as a society. We are, I like to think from a population standpoint, we've turned into a 5-year-old. We have no concept of future, no concept of past. It's right now, me. And that will have dire consequences at some point in the future.
Sure, and like you said, most people are spending them. Or excuse me, most people are either paying down debt or saving.
They're just
the money.
saving it. We're enriching ourselves on the
go.
basis of our children.
Sure.
And as somebody who has kids, I find that just tragic.
Okay, well, good point. Well, thank you. So I have a couple questions here. I'm going to jump right into them. These are a little bit more specific to Orange County, I guess, as a whole, but items you did talk about. Yeah. And so for especially South Orange County, but we have the Laguna Hills Mall, we have the outlets in Mission Viejo, we have the Kaleidoscope, we have the Irvine Spectrum, obviously. But you kind of talked about it. Is the retail sector, I mean, we're starting to see this wane, right, where people go and they shop at a mall. What you kind of said where it's going to go, but let's reiterate that. Where do we need to go when it comes to this type of shopping?
And it's interesting to do because you laid out lots of different kinds of models there, right? Let's talk about Irvine Spectrum. That's not going anywhere.
Yeah.
Because that's not just shopping. It's an entertainment zone. You have live music. You have a beautiful outdoor area. It's got tons of restaurants and movie theaters. It's a destination. Yeah. Destination retail will remain popular because people are going there to see and be seen. We like the social experience. We like being around other people. And when it's done in a nice setting, of course it's going to succeed.
Sure. And it's surrounded by homes.
And it's surrounded by homes. The real problems we're talking about here are going to be the more what are called suburban. Think of that suburban strip mall where you have, a dry cleaner, a couple little convenience stores, maybe one of these bulk goods stores. These are the guys who are going to suffer. And we have too much of that space, and that's what we have to figure out what to do with.
Okay, good point. So healthcare was obviously a topic of 2020, as everyone can imagine.
Yeah.
But looking at the healthcare through the economic prism, it seems that, for example, South Orange County's aging population, this might be a widely growing economy, obviously, as everyone starts to age. And so we have UCI Health, we have Memorial Care, we have Mission Hospital, we have the City of Hope in Orange County. Yeah. So where do you see healthcare going, and specifically in our region?
Up, right?
Yeah, sure.
And it's interesting because you think about the changes in office space, right? A lot of companies are downsizing. But anecdotally, what I've heard is the one place, if you're in like the healthcare office space sector, you're doing great.
Sure.
Because not only are we, not only, look, healthcare and healthcare office space, it's the one growing part of the economy that's been so consistent over the last 20 years. But it's not just that. Doctors are now taking more space per doctor, per patient. They're expanding. They're thinking about the health consequences. They're now more cognizant than taking 9 sick patients and putting them in one tiny little waiting room. Probably not the smartest thing in the world.
Right.
And as a result of that, they are going to fill up a lot of the office space. So particularly suburban office buildings. You know, if you're a suburban kind of B office building, your best bet is to get rid of everybody you have in there, get rid of the insurance guys and all that, and turn it into an office building for doctors, turning it into a medical plaza. That's where the demand's going to be.
Okay, well, very good perspective. Thank you. So another question is, you kind of touched upon it earlier, but the government sector.
Yeah.
You talked about the local, specifically city of Anaheim. I mean, you talked about Disney a little bit. You talked about Riverside County. So is it a lagging effect when it comes to cities and how they'll ultimately be affected? Specifically, how is this going to affect government workers and then city budgets maybe over the next 2 or 3 years?
Well, there's a lot packed in there, and let's remember that local government in California was already between the proverbial rock and a hard place, right? Local governments here are constrained in the ways they can raise revenues. For example, you're not legally allowed to have a local income tax, whereas New York City famously has a local income tax because they need it. It's an expensive place to run, and they need to be able to get that extra revenue source. The cities here are constrained, which is why you see sales taxes going up and up and up and up. What are they at 10% in a lot of parts of which is crazy high when you think about it. And now an important source of their revenue, that is the local taxable sale, is moving to warehouses. Now there's a weird phenomenon, you know, think about Riverside versus here, because 20 years ago, Riverside was screaming that all the Riverside residents would go to Orange County to shop. And now Orange County is screaming because everybody in Orange County is getting their goods out of a distribution center in Riverside. And so, you know, the tables have turned. But what we do have to take a step back and say, look, these guys have to have ability to raise revenues to just pay to keep the lights on. Now, the other side of it, which I have to acknowledge, is the other problem they have is not just the inability to raise revenues, but of course, the pensions in California are out of control. And we have made very little progress on that. In fact, if anything, the pension situation is going to become dramatically worse, because one of the things that this pandemic has created, and it's a quiet thing, but it's happening, a lot of senior folks in government are taking off. They're taking that retirement. And you know, these guys can retire. You're 52, 53, 54 years old. You're retiring with close to your full pay. And in a lot of cases, because of we have this weird incentive, right? They don't care about the long run pensions. Remember, a city council person is only thinking to the next election. 2 years. That's your entire world is 2-3 years out. That's it, right? And yet these pension systems are decades, you know, and the decisions they make are very clear. I have a problem right now, and because I don't have enough budget, and I don't want to cut people's hours because then the public unions are going to be angry at me. So the best way of shortening my payroll right now is to give people early retirements, to incentivize them to get out. And you're seeing this exodus of senior leadership in so many parts of local government as they try to get them out for the short-run considerations. Well, that's going to create big stresses in the long-run pension problem. And by the way, a lot of folks are going to wonder what happened to the person I used to know in local government who actually knew where the bodies were buried. He's retired, and now I'm dealing with a whole new set of people, which again is going to create all sorts of issues.
Interesting. Okay, so this could have a long-term effect as it relates to pensions, which is a good point, something we didn't think about. So that's the questions I have for you, because we do have some questions from the audience, and so we are going to jump right into that. We asked folks to submit their questions via video online. Unfortunately, it's not the in person that we wish we were doing.
Or better yet, over a beer at the bar, right?
Exactly, and I definitely missed our convention, so I definitely agree with you. But this question comes from Realtor Rita Tayanyaka about the hot housing market. Rita.
My question for the economists is, how are we going to sustain this level of craziness in the housing market and the lack of affordable housing in the area, anywhere close in the area?
Okay, thank you, Rita. So, Dr. Thornberg, I guess, does the housing market, the real estate industry, does it have a kryptonite?
Oh, I guess the question is there a danger of, well, there's two ways of thinking about that, right? Because when you think about the craziness in housing prices, the question is are these housing prices unsustainable for the people who are buying them? The answer is, believe it or not, they are not. As crazy high as they look, low interest rates and rising incomes for higher income families has led to a situation that even with these crazy high prices, over the past 10 years in California, you've seen declining housing cost payments to family income percentages. I know it sounds weird, as high as these prices are, that number continues to fall.
Sure.
So these numbers are reasonable, they're not going away, and they're not going to collapse anytime in the near term. Now, the second question, which I think is far more profound, is, okay, but what is our economy going to look like? Because if you don't have enough housing, you limit it the way we've limited it, that means you're allowing a group of people to have an ability to have a great lifestyle in one of the best places on earth called Southern California. But everybody else, sorry, you know, and the term I've used in the past for this is we are turning this into Country Club California. Hey, it feels great, you know? But that's only because we're basically building a situation by which if you don't meet our income standards, move to Arizona or Nevada, chump. We don't want you here. That's not the kind of economy I want to live in. It's going to be an economy that is fundamentally limited in how it can grow. There are many parts, the historic parts of our local economy that are not going to be able to deal with this, and they are going to move. Think of like, the movement of Tesla to Texas, for example, right? Well, it's because of regulations? No, it's not. Look, he's building cars, and cars need a good, stable, middle-class workforce to put those things together. That doesn't exist in California because housing is too expensive. He's moving to Texas because of housing costs, not because of business regulations. So she's absolutely right. It is a huge issue. And by the way, it's not an affordable housing crisis. I hate that term. It's a housing supply crisis. I don't care what you build as long as it's a lot more than it is right now. That is the solution. But when the state government is not willing to open up the spigots, then it becomes an affordability issue, and then they run around combating affordability, which, by the way, just hurts supply, making the situation worse.
Exactly. Now, actually in your research, kind of a question I like to ask a lot of economists, but where do you see most of the younger generation going out of Orange County? Are you seeing it? I mean, I'm probably going to say the answer here, but Idaho, Texas, I mean, that's kind of where we're seeing a lot of it.
I think Texas, I think Arizona.
Sure.
Look, Phoenix is the fastest growing major economy in the nation, and it's been that way for a while now. They're very proud of it. There was an op-ed in the Orange County Register by the governor of Arizona not too long ago going, hey, come on, we're open, we're ready for you.
Sure.
And the reason they're growing so rapidly is because of California. The numbers are incredible. You're talking close to 100,000 people a year leaving California, going into Arizona, because they have housing that's affordable. Now again, the solution here is housing, housing, housing. Gavin Newsom got into office talking about housing. And candidly, nothing's been accomplished.
Sure. Well, we have another question here from the Fountain Valley Chamber CEO, Memory Bartlett, and it's about tourism. So, Memory.
South County has some of the best hotel and tourist destinations in our region. Do you believe that there's a pent-up demand for travel, or does Dr. Thornberg believe that people will still be hesitant to leave their homes throughout 2021?
Okay,
another topic you touched on.
And absolutely.
I think I know what you're going to say here. But as you said, where is tourism going to go? Is there pent-up demand?
Oh my God, pent-up
Hopefully
demand.
Hopefully the answer is yes.
It's the understatement of the century,
exactly.
Right? People are just chomping at the bit. And what's interesting about that is I'm a little surprised talking about specifically South Orange County, because I think South Orange County, I'm thinking Dana Point, right? Dana Point's been on fire, folks. Yeah. Oh, yeah. It's already been busy. You go look at the resorts down there, whether it's the Ritz-Carlton or the Monarch Beach. These places are wall to wall because people are going out. Yeah. They want to get out of their house. They want to go someplace. So they're already busy. Now, the part of the conversation which isn't there is the convention conversation, right? And we know that the driving guys are good, but it's not the same kind of business you get from the conventions.
Sure.
The conventions, you get the add-on, you get those big markup, wonderful meals, and you got lots of cocktail sales and all sorts of stuff. That's going to come back like nobody's business. It's going to lag. But again, think about that survey I talked about in my presentation. 77% of business people are like, I want to go to conventions.
We don't want to go to conventions on Zoom.
No, we want to be there. We want to be in person. It's about the networking. It's about the entertainment. It's about that in-person feeling. It's going to come roaring back. The thing with conventions is this: it takes a year to plan these things, and you're seeing them getting into the pipeline. 2022 is going to be back up and running. 2021, I think, towards second half of the year, you're going to see people going, oh, well, let's do this, and they're going to be throwing stuff together quick. But the big conventions, that part of the world, that part of the travel world, that part of the hotel world, that's a 2022 recovery.
Okay, you're hearing it from here then. 2022.
Yeah,
it'll be the year of the convention. So one last question from the audience, from the public, I guess. This one from Ron Stein, and he wants to know, in light of our state's policy, which are not friendly to business in any measure, will California be the last to recover? So let's hear from Ron.
Hello, this is Ronald Stein. My background to my question. Over the years, California has lost most of its manufacturing job opportunities and has become a heavily oriented service state in the hospitality and food industries, both of which were devastated by the pandemic, resulting in many business failures and job losses. In addition, California is trying to lead the country to go green, but California's dysfunctional energy policies have already made the state's electricity and fuel prices among the highest in the nation that have been contributory to the rapid growth of energy poverty and some of the highest unemployment, overcrowding, homelessness, and poverty rates in America. For the 18 million people, which represent 45% of the population, which are Hispanic and African American. My question: as the state recovers from the pandemic, many of those unemployed people will be ready to go back to work, but with all the business failures, there may not be places to go back to work. Will California, this is the question, will California, with its heavy business unfriendly laws and regulations and high cost of living for those that can least afford expensive energy, which drives up the cost of everything else, be the last state to economically recover from the pandemic? Thank you.
Okay, thank you, Ron. So, Dr. Thornberg, our state's economic outlook.
Yeah, and like, I appreciate his frustration. I too am frustrated by the state of California, but as frustrated as I am, I would also go back to a very fundamental point here, which is that there is very little correlation between business friendliness and economic growth. Sure. It's just that simple. California succeeds in part because California is California. It is one of the most sublime places to live. Yeah. It has incredible natural resources. It's got a great location, and it's got some of the highest skilled people on the planet who come here to basically enjoy all that. And for them, the dysfunction is not a big enough deal for them to leave. Now, for anybody who doesn't believe me, there is a very simple metric. The day that California becomes so business unfriendly that people don't want to live and work here, you will see that in home prices. That is the ultimate equilibrium factor. Home prices will come down.
Good point.
When you see home prices going through the roof right now, what it says is no matter how crazy you think Sacramento is,
people want to live here.
People want to live here, okay? It's as simple as that. Now, to that point, go back to the idea of a labor shortage that we had coming into this. California's problem is labor shortages, which are driven by housing shortages. Exactly. And it will constrain our ability to grow. I do anticipate we're going to have a rapid recovery, and then we're going to basically merge with the stall we were already in prior to this. Because in the first few years after the Great Recession, California outgrew the nation substantially. We were seeing 3% job growth per year when the nation was seeing less than 2%. Starting about 2017, early 2018, that changed, 2017, where we started running out of people. We weren't building anywhere else plus housing, and you saw California slow below national trends because of that labor shortage. Now, He's right. Some businesses aren't going to reopen. There's going to be slack in the labor supply. But this state will quickly absorb those people, and then we're going to hit that wall again. It's housing,
Sure.
housing, and housing. Did I mention housing?
I think that was 5.
Yeah, I think
Okay,
so.
good.
It's so critically important. And yet, again, Sacramento is running around begging for money from the federal government they don't need, passing eviction moratoriums, which they don't need, panicking about existential threats that they don't need to panic about.
Sure.
Oh, and by the way, one last thing. Our energy markets are dysfunctional. Has anyone seen Texas lately?
Yeah.
I appreciate the worry, and I appreciate his frustration. But that's not the central issue here.
Okay, good point. Well, thank you. So I do want to end on a positive note. Not that your presentation wasn't a lot of positive discussion, so definitely optimistic about that. But any silver linings from this pandemic? I think I asked you that same question last year.
Yeah.
But anything, again, silver linings over the last year?
Silver linings, I think, are a couple things here, okay? I think that we got lucky. Remember,
Sure.
Spanish
Yeah,
flu
sure.
was 100 times more deadly, and we need to be better prepared next time around.
Good point.
I think that we're all going to be a little smarter about basic cleanliness. You know, Japan, Korea never had anywhere near the problems the United States with, and that's in part because they dealt with earlier coronavirus problems, SARS and MERS.
Yep.
The populations over there were already kind of culturally attuned to wearing masks
Sure.
in public places and things like that, and they never had the problems we did. You know, sadly, wearing a mask became conflated with culture wars, which to me is bizarre. Wearing a mask when you have a sniffle is called being a human being, people.
Sure.
And I hope that we come out of this with that, because that's going to make the flu season a little less bad for us, right?
Exactly.
And you have kids like me.
Yep.
We can both appreciate how our kids
Yep.
have not been sick over the
And
last
that's
year,
true.
which we will when they do get back to school and they start coming home every 2 weeks with every
they'll be
horrible
sick again.
thing.
Yeah, exactly.
We're gonna go, oh man, there was that silver lining
Wear
to
your
that
mask.
thing. One more thing too. Let's go back to the conversation about underlying trends.
Sure.
We knew that our roads are excessively busy because we were still working in models of the past, where people needed to come to the office. And I can tell you, my company specifically, you may have found this yourself, but we let people work from home here and there in the past, and it never worked out. And then we had to do it this time,
Yep.
and we had everybody doing it, and it was going to be an extended period of time. And what we learned is the failure of work from home in the past was on us, not them.
Sure.
Because
Okay.
we didn't put the systems in place.
Yeah.
We didn't have the software. We didn't have the management structures, the team meetings, the day-to-day contact necessary to make people productive from home.
We had no choice this time.
We had no choice. And as a result of that, I do think we're going to take a little pressure off folks. We are going to let them be able to work from home a couple of days. It's good for the environment.
Yep.
It's good for our workers. It's going to be good for our businesses. It's going to be good for our roadways.
Yeah.
And I think that silver lining is something we should all take advantage of. Again, the office isn't dead.
Yeah.
But we learned a lot. And let's take that learning and carry it forward with us.
Yeah, and good for our sanity, not having to sit in a car for
Yeah,
hours on our
absolutely.
commutes. So I'm definitely going to be appreciative of that.
Yeah.
So any last comments that you'd like to leave for our audience?
Again, I said it in my presentation, but it's the best metaphor I can think of. It's going to be, the economy is going to be rocking by the end of the year. Enjoy it, but again, leave the party before the police show up.
Sure.
This thing could get overheated, and that's when people make rash decisions. That's when you extend too far.
Exactly.
Keep your wits around you. Keep an eye on policy. Keep an eye on the fundamentals. Come back to my talk next year. But again, economy's going to be roaring by the end of this year, and there's a lot of good things in front of us. A lot of make good, but be careful.
Okay, thank you.
My pleasure.
And that is all the time we have for today. I would like to once again thank our sponsors, title sponsor UCI and UCI Health, and our presenting sponsor, Orange County Supervisor Lisa Bartlett, for making today's program possible. In addition to UCI, UCI Health, and Supervisor Bartlett, We'd like to thank our gold, silver, and bronze sponsors for today's show. We cannot bring you this important information without their underwriting support. And thank you again, Dr. Thornberg, for sharing your insight with us. Your presentations are always a great window into the true state of our economy. If you'd like a copy of Dr. Thornberg's presentation, please visit our website, economiccoalition.com. I also want to thank you, our viewers, for joining us today. Please plan to join us again next month on April 23rd for our Transportation Forum. Also, if you're interested in becoming a member of our coalition, we have many sponsorship levels available on our website, economiccoalition.com. I'm Steve Lamott. Thank you for joining us today. We'll see you next time.